Hi, everybody. Welcome to Bonding Over Bonds. I'm Allie Krautheim, and today I'm joined by Jim Jackson. Thanks for being here today, Jim.
It's great to be here, Allie.
Now that we're in the final throes of 2024, what are some of your takeaways from this third quarter? Or is there anything in particular you're looking forward to in the next 3 months?
Sure, I think the biggest takeaway for the third quarter was that Treasury yields moved lower across the curve. So what we saw due to lower yields was pretty robust performance across fixed income. Now in the fourth quarter, what we've seen is GDP growth has been stronger, job numbers have been pretty robust. So we've seen yields start to move up on the risk that the Fed might not cut rates as quickly as was expected by the market during the third quarter.
Absolutely. Expectations have shifted significantly since last year and even within the last month about what's going to happen with the Fed. What's something important for fixed income investors to understand about how fixed income performs once the Fed begins its easing cycle?
Sure. I think the biggest takeaway is that when the Fed starts to cut rates, you typically see pretty robust performance in the intermediate part of the curve. And historically, what we've seen is the intermediate part of the curve outperforms the short end, and the short end outperforms the very short end that's most impacted by the Fed funds rate.
Absolutely. So, as money market yields are likely to track the federal funds rate as this cutting cycle progresses, then would it be worthwhile for them to consider moving into fixed income?
We think it makes sense. What the risk that you take on the very short end of the curve with a money market product would be reinvestment risk. So as yields start coming down, they will be most impacted on the very front end of the curve for money market yields. So we think it makes sense to balance those risks and start to move further out the curve into the intermediate part of the curve.
Great. Thanks for that insight, Jim. And thanks to all of you for bonding with us over bonds.